Happy New Year. This is Jonathan Satovsky of Satovsky Asset Management, January 4th, 2017. Wanting to give a quick update of the year that had just passed and look forward into our crystal ball as to what we can anticipate for 2017. So I start with a little debt of gratitude and appreciation for those investors who have been loyal and patient and have been able to sit still through what was a tumultuous 2016. And those investors were nicely rewarded as the year ended out quite positive, I think to many people's surprise. And I wanted to talk about the 3 times a year that we experience massive surprises or downside risk in the financial markets. This has happened since 1800. On average, 3 times a year we've had 5% declines in the US market alone. So 2016 from that respect was no surprise, but the reaction and the emotions that came with 2016's headlines and declines felt much more visceral than most other years. Maybe the headlines had exaggerated the emotional tenor to the situation. But we started 2016 with the worst decline in market history from January 1st to February 11th, which caused many investors to abandon their long-term plans altogether and paralyzed other investors from making investments for their future, only to see the markets recover. Then we had Brexit, which led to the greatest redemption day in market history, only to see the markets recover. And then we had 9 days pre-election, which had a massive slide. And many investors, I would say 2 a day, were calling us to tell us, shouldn't we sell everything and buy it back after the election, only to see the markets have a massive snapback through the end of the year. So patience is extraordinarily important. More important is actually knowing yourself as an investor. So if we take those lessons into 2017, when we have these occurrences in 2017 and beyond, how are we going to react to it? Are we going to panic and curl up and wait for, try to avoid losses? And, that is the common reaction because there is a pleasure-pain principle. $2.50 of gains equates to $1 in loss in terms of people's reactivity. So people have a much faster reaction on the downside than they do on upside. Do we sit still, or do we lean into the wind and be greedy when others are fearful, in the Buffett ideology to invest when most people are afraid to invest? Well, it's tested every single day, and you don't have to look any further than looking to the foreign markets, for example. Foreign markets were down in 2016, and they've actually had 0 return the last 10 years. So if you're a foreign investor, whether you're an indexed or an active investor, the indexes, the MSCI EFA, or All Country World ex-US, has returned 0 the last 10 years. Meanwhile, the US equity markets, as measured by the S&P 500, are up close to 85%. So going forward in 2017, do you abandon all your foreign investments to pile into the US? Or do you continue to maintain your international exposure when it's just as likely that the next 10 years foreign markets may be up 85% and the US markets could be flat? So the idea of maintaining a diversified portfolio is to be able to have a path that we can sit still long enough to be able to capture the returns necessary to achieve our goals, whether it's educating our kids, whether it's retiring, whether it's buying a business or buying a house. People have ambitions. So in my mind, what's logical is that whether you're an endowment or an individual retiree or someone saving for the future, if someone's spending 3 to 5% of their money, they need to target a return on the assets that they have at close to 7 or 8% a year. And the math for 99% of the population is not going to work without taking risk, without living with volatility, without owning assets. So my preference has been to lean clients' portfolios much heavier toward the ownership mentality to the degree that they can sleep at night. Most people aren't comfortable with 100% equity exposure, but some gradation of volatility therein. But the idea is you want to lean toward owning assets, owning small, cheap, and profitable companies. And to reinforce that, the last 10 years, we've had a 10-year period from 2005 to 2015 that US value has underperformed growth, third largest underperformance in history. The The last two times ended in 1939 and ended in 1999. So I would expect, my prognostication is that the decade ahead should be very favorable for the value orientation and the mindset of owning quality. Have a wonderful new year, prosperous, good health, and good fortunes to all.